Hello everyone, this is Blago. Today we're going to create a financial model for a restaurant within 30 minutes using Modeliks. Now, Modeliks is a financial planning and reporting solution for startups and SMEs. I'm the founder of Modeliks, so I will walk you through how you can create a financial model for a restaurant using Modeliks in 30 minutes. Modeliks offers financial model statements by industry. Restaurant financial model template is one of them. So we're going to start. With the predefined financial model template within Modeliks to make our job significantly easier. You don't have to be a financial modeling expert to have a professional financial plan for your restaurant. Just watch this video. It's going to take less than 30 minutes, and within today you can have a financial plan for your restaurant. Without further ado, let's jump into Modeliks. This is Modeliks. We have preloaded the financial model template for a restaurant business in order to make our job of making a financial plan for a restaurant significantly easier. Now, in order to create a financial plan for our restaurant or for any business for that matter, we have to provide assumptions for the 8 sections that we see here in this banner. Our revenue assumptions, cost of goods sold or our direct costs, employee assumptions, expenses, assets that we will need in order to run the business, financing that we might need, taxes, and working capital. Once we have provided assumptions for these 8 sections, our financial plan for our restaurant will be automatically generated. What that means is the 3 most important financial statements automatically generated, meaning a profit and loss statement, a balance sheet, and a cash flow statement. So let's start with our revenue assumptions. Now, in order to calculate the dine-in revenue, or in order to calculate our revenues, most restaurants will have three types of revenue streams. One is dine-in revenue from people eating inside the restaurant. Number 2 is takeout revenue, and number 3 is delivery revenue. Now, let's start with dine-in revenue. To calculate our dine-in revenue, we will calculate the dine-in revenue by multiplying the number of total dine-in bills that we can expect from our restaurant by the average spend per bill within our restaurant. So the number of dine-in bills for a restaurant should be calculated based on 3 operational variables or drivers relevant to the restaurant business. Number 1 is the number of tables that we have in our restaurant. And let's assume this is a small restaurant that we're talking about here that has a total of 10 tables. I'm going to copy paste the number 10 as number of tables to the end. Second variable is the number of table turns per day, or how many times do we expect each table to change customers during the day. So let's assume that we can expect that on average each table gets 3 customers per day. And then what is the number of opening days per period? Let's assume that our restaurant is open every day in the year. So the number of opening days per month and per year is the number of days in that month. With that, we have calculated the total number of dine-in bills we can expect from our restaurant. Now, the last assumption here is that we need to provide is the average spend per bill, or how much is each client going to pay on average for eating in our restaurant. So let's assume that on average for one table, clients pay $50 on average. With that assumption, now we have calculated the total dine-in revenue for our restaurant. That's it. Let's move on to our takeout revenue. In order to calculate our takeout revenue, we're gonna multiply the number of takeout bills multiplied by the average takeout price. To calculate the number of takeout bills, we just need to provide one assumption, and that is what is the takeout bills as a percentage of the total bills for our restaurant. So let's assume that we expect about 10% of our clients to take out food. We use that 10% over time, and with that we have calculated the number of takeout bills. The last assumption that we need is the average takeout price. Now we said that it's about $50 on average for dining revenue. Usually takeout bills would be lower than that. So let's assume that on average the average takeout price is about $35. And with that, we've calculated our takeout revenue. Finally, let's calculate our delivery revenue. Again, it will be calculated as the number of delivery bills multiplied by the average price per bill. To calculate the number of delivery bills, we just need to provide one assumption, which is the percent of delivery bills as a percent of total bills. Again, let's say that we expect about 30% of our clients to order delivery. Copy paste that over time. And with that, we have calculated the number of delivery bills for our restaurant. Last assumption is the average spend per delivery bill. Usually, there will be the price of the delivery price or the price of the food plus a delivery charge. So the delivery price, let's say it's about again $35, the price for the order, and plus $5 for a delivery charge. Paste again. And with that, we have now calculated the average spend per delivery bill and the total delivery revenue. And that's it. Now we have our revenues for our restaurant already calculated. Let's move on to cost of goods sold, or our direct costs. Now, there's several types of direct costs in a restaurant. There's the food and beverage cost, a takeout packaging cost, delivery packaging cost, delivery fee platform if you're taking orders to different delivery platforms, payment processing cost, and waste cost. So let's go one by one. Food and beverage cost. We'll calculate it as a percentage of the food and beverage revenue. Usually in a restaurant, you should be somewhere around about 35%, 30 to 35% of your revenue should be the cost of the food food that you require to prepare the order. So let's say 30% of the revenue is our F&B cost. Copy paste that over time. And with that, we've calculated our food and beverages cost. Next is our takeout packaging cost. We'll calculate it based on the number of takeout bills multiplied by the packaging cost per bill. We already have the number of takeout bills because we calculated when we were calculating the revenues, takeout revenues. The only thing we need to input is the packaging cost per takeout. So let's assume it costs us $1 of packaging cost per takeout order. That's it. Our takeout packaging costs have been calculated. Next, delivering packaging cost, similar to takeout packaging cost. Let's assume that it costs us $1 to pack the order for delivery. Copy paste all the way to the end. Now we have our delivery packaging cost calculated. Next, delivery platform fee. And this is the fee that we pay to third-party platforms if we are using a third-party platform for our delivery. So let's assume we do use a third-party platform and it costs us about $4 per delivery as a fee. Copy paste that all the way to the end. And now our delivery fee, platform fee has been calculated. Next, payment processing costs. Now, payment processing costs, we need to provide inputs for two specific variables. One, what percent of our sales are paid by credit card, because there will be a processing fee connected to the credit card. And then what is the payment processing fee that our bank charges us? So let's assume that about 50% of our sales are paid by credit card. The rest are paid in cash, which do not have a processing fee. And for those orders that are paid by credit card, let's say that the processing fee is about 2% of the bill. Copy paste that all the way to the end. And now we have calculated the payment processing fees for our restaurant. Finally, waste costs. It's inevitable that in every restaurant there will be some food that is wasted, it goes bad. So the lower that the waste costs are, the better. But let's assume in this case that our waste costs are about 2% of our revenue. So we'll calculate it as a percentage of revenue. The waste cost will be calculated as percentage of revenue. Let's say that about 2% of our revenue is waste. Copy paste that all the way to the end. And now we have calculated the final direct cost, the waste cost. And we have calculated the total direct cost for our business. We can go up here, and what we can see in the chart that if you click here on the show gross margin, we can see that our gross margin for our restaurant is around 63%, which is a healthy gross margin. We move on to employees. Now, when we look at employees in a restaurant, in the template has only the basic employee types. If you need more employee types within your restaurant, if it's a bigger restaurant, then you can add more employees. Within the template, we have waiters or front of house. We have support staff, back of house. We have our chefs, restaurant manager, and then the owner. So let's start with waiters. How many waiters do we need for our to hire for our restaurant? Let's say that we need about five waiters. We'll copy paste that all the way to the end. And what is the total gross salary that we pay for our waiters per month? Let's say that we pay them about $4,000 gross salary, and we copy paste that to the end. Then we'll go to our support staff in back of house. Let's assume that we have 2 people that we need in back of house as support staff, and their salary is about $3,000 per month. Paste that to the end. And finally, we'll look at our chefs. We will need 3 chefs for our restaurant, and their salary is $5,000 per month. With that, we have calculated our salaries for chefs. Now we go finally to the restaurant manager. This is usually 1 person. Number is 1, and their salary is $6,000 per month. Copy paste that to the end. And finally, the owner, 1 person. And let's say he has a salary of also $6,000 per month. With that, we have calculated that we have a total of 12 employees and the total cost per employee. We move on to expenses or operating expenses for our restaurant. Now, first, marketing expenses. We'll calculate them as percentage of total revenue. So let's say that about 10% of our revenue will go into marketing. Then rent. Rent expense, usually calculated per square meter. So we have our restaurant that is about 200 square meters. And the price that we pay per square meter is, say, $20. Now our rent expense has been calculated. Then we're going to maintenance, repair, and cleaning. This will be calculated as a percentage of revenue. And let's say that about 5% of our revenue goes into maintenance, repairs, cleaning, and so on. Utilities and telecommunications. How much do we usually pay? Let's say it costs us about $500 per month for utilities and telecom expenses. Copy paste that all the way to the end. Insurance, $400. Cost for insurance of our restaurant per month, $4,800 per year. Any other licenses, permits, and other concessions, other expenses. So these are again about $600 per month. IT and other software, about $400 per month. Paste that to the end. And then other expenses, usually calculated as percentage of revenue. So we'll say that another 5% of our revenue will go into other expenses for our restaurant. And with that, now we have calculated the total expenses for our restaurant. Let's go into assets. Now, what kind of assets do we need for our restaurant? Well, first of all, we rent the space, so let's see if we would have to do some kind of improvements to the space that we're renting. So we'll go into edit, building improvements, and this will be a long-term asset that will depreciate over 20 years. And let's assume that we will do the improvements in the first month of our plan, and we'll spend about $20,000 for improvements of our rental space. Save and close. Then we have our furniture and fittings that we need to fit out our restaurant. Again, this is a long-term asset that will depreciate over, say, 5 years, and we will fit out the restaurant in the first month of our plan, and we will spend about $100,000 for fitting out for furniture for our restaurant. Click Save and Close. Next, we have kitchen equipment. I'm going to edit. Again, it's a long-term asset that will depreciate, let's say, over 10 years. And we will need to fit out again in the first month of our plan. Let's assume that our kitchen equipment costs about $150,000. Close. And finally, any other computers, other equipment that we might need for our restaurant. Go into edit. Computers, usually this kind of equipment is depreciated at a shorter period of time. Let's say we will depreciate it over 3 years, and we will spend about $20,000 on such other equipments. Save and close. With that, we see that we have calculated our total assets that we need in order to run our restaurant. Now, what we can see here is that our cash balance is negative. So we'll need some financing in order to finance these assets and these equipment that we buy in order to fit out our restaurant. So that takes us to financing. In financing, we'll have two things. First thing is the owner's equity, or the investment that you as a restaurant owner will make into the restaurant. So let's say that you're prepared to invest $100,000 into your restaurant in the first month of our plan. We click Save and Close, and the rest of the money that we need for our in order to finance our fit out and kitchen equipment, we're gonna do it through a loan. So we'll have a startup loan here. We'll go into Edit, and we'll say we'll take the loan in the first month when we need to buy the equipment, and we will take a loan of $400,000. We'll pay off the loan in 60 months and with an interest rate of 6%. We'll pay back the loan monthly. Every month we'll pay back the loan. With just those few inputs, we'll calculate all the cash flows from this loan. Now, with that, we have finalized our financing section. We go into taxes. Usually, every country will have income tax. So we'll go into edit, and then the income tax will input the income tax rate for your country. Let's say this is 15%. That's it. Just that one input for income tax. We click Save and Close. And our income taxes have been calculated. They are zero because very likely we are making a loss based on the financial projections that we have so far. But we will come back at the end and see what kind of changes we need to do to our financial plan in order to become profitable. Final assumptions: working capital. There are 3 assumptions here, and accounts receivable assumptions, inventory assumptions, and accounts payable assumptions. Now, first, let's calculate our accounts receivable. 2 inputs. 1, credit sales. What percent of our revenues are going to be invoiced to clients and paid to us at a later date? So let's assume that every single order is paid right on time when it is ordered. So 100% of our sales it will take 0 days for them to get paid. Inventory. This this input is the inventory days. And what this means is that how many from the time that we buy all the food and beverages that we need for our restaurant to function, how many days do we hold them in inventory before we actually sell those products? So this is a restaurant. There has to be a quick turnaround of food, especially food and beverages. So let's assume that from the time that we buy our inventory, we are able to sell it in about 10 days on average. And then accounts payable is there again two inputs. One, what percent of all the purchases that we do, and this is mainly all the purchases for our food and beverages and other purchases that we do, we pay them on an invoice with credit terms at a later stage. So let's assume that our suppliers give us 100% of the things that we buy. Our suppliers give us payment terms of 30 days. And with that, our working capital has been calculated. Now, we've gone through the main 8 sections. Let's look at our financial plan, how it looks like. We're going to report. And the first thing we want to look at is our profit and loss. Let's look at it first on annual level. Total revenues, 800,000, 830,000 per year. Gross profit, 500,000. And then we go down, we see that our EBITDA and our net income are negative. This means that we have more cost than revenues, and our business is not profitable. So unless we are able to either reduce our costs or increase our revenues, this business will not be profitable. So maybe we were a little bit too conservative on the revenue side. Let's go back into revenues and see whether there is anything that we can improve. Let's look at the dining revenue. We said we have 10 tables. That's it. We have 10 tables in our restaurant, and that our table turns per day are 3. So on average, each table gets 3 customers per day. Maybe this is a little bit too conservative. Maybe we can expect that each table turns about 5 times per day. We'll copy paste that all the way to the end. And now that increased our revenues. Let's go back into our profit and loss and see whether we have become profitable. No, we're still loss making. Okay, now let's look at our operating expenses. First, let's look at our employees. For this number of tables and number of orders, maybe we assumed too many chefs and too much support staff that we'll need. We said we'll need 3 chefs. Let's reduce that to 2 chefs that we'll need. And let's reduce the support staff, 2 people in support staff. Okay, that we cannot reduce there much. Now, if this is the potential of this restaurant, then maybe we do not need a restaurant manager. The owner can be a restaurant manager, or maybe we don't need the owner. There is too much duplication at the management level. So let's say that we will not need a restaurant manager. The owner will be the restaurant manager. So 0 employees in the restaurant manager. Next, go back to reports. We are still loss making from what we can see. Okay, let's go back to revenues one more time. Maybe we were a little bit too conservative with the average spend per bill. We said that clients pay $50 per bill, but maybe this is too conservative, and we'll say that on average, one table pays $70 per bill. Copy paste that all the way to the end, and let's look at our takeout revenue assumptions. Average takeout price, we'll increase that to 50. And our delivery revenue price will increase that to 50. You see how Modeliks allows you to just change one assumption and automatically see how that impacts the full financial plan for your business. Now, let's see. We have finally started to make profit. We have a net income at the end of almost 200,000 at about 10% net profit margin, which for a restaurant is kind of the minimum that you should be going for. But it's the minimum. So this is what your restaurant can make, and that's it. Now we have our financial plan ready for our restaurant. We can look at the profit and loss on a monthly basis, see how that looks like. You see, we are starting with 18,000 net income in the first month. Then it goes all the way. Then it calculates for every month and then for every year. That's our profit and loss. Let's look at our balance sheet. This is our balance sheet, the total assets, the total liabilities that we need for our business. And finally, let's look at our cash flow statement, which is very important to make sure that we are not running out of cash at any point of time. Let's look at it on a monthly basis. What we have is total cash balance is always positive. And we see that at any point of time, we have about $300,000 and more in cash balance, which probably means that the loan that we decided to take of $400,000 is not needed to be so high. So we'll go back into financing. We'll say, okay, start up loan. We'll not take a $400,000 loan. We'll just take a $200,000 loan. Close. Going back to our reports, let's look at our cash one more time. Cash flow statement. We see that our cash is around 100,000 and grows over time, which we should have some buffer for in terms of cash. So we are happy with this financial plan. And that's it. We have been able to create a fully professional financial plan for a restaurant business within less than half an hour. Within Modeliks, apart from the top financial, the most important financial statement, profit and loss, balance sheet, cash flow statement, you can also look at your employee schedule or several charts for you to visually understand how your financial plan for your restaurant looks like. So you have your revenues, your gross profits, your gross profit margins, you have your operating expenses over time, EBITDA margins, and so on. This is on a monthly basis, and then if you want to look at it on an annual basis as well, for the 3-year period for which we created our financial plan, you have your revenues, your EBITDA, net income, you have your profit margins, gross profit, EBITDA, operating profit margin, net income, and so on. Every single chart that you need in order to understand how your financial plan will look like for your restaurant in the future. I hope that was helpful. We were able to create a professional financial plan within 30 minutes with Modeliks. Now, you see how in Modeliks, once you've put in your initial assumptions for your plan, it might turn out that you need to do little tweaks here and there on the assumptions in revenues or in cost. And it's very easy. You just change one variable and you see what is the impact of that change on your total financial plan. You can do as many scenarios as you want in order to come to the right financial plan for your restaurant. We will end this video here. If you want to create a financial model for your restaurant today, go to modeliks.com. There is a free trial, 15-day free trial. Try it out and enjoy. Have a great day, everyone, and I hope this was helpful.